Thanks. Well, Dean Maki, chief U.S. economist at Barclays Capital, has been saying all summer that a double-dip recession is unlikely. According to the most recent Bloomberg data, Maki is one of the best overall forecasters of the U.S. economy, making him a Bloomberg best. He joins Matt and myself right now. Dean, great to have you back here on Street Smart. So you've got Buffett ruling out a double-dip. You've got surging Chinese output. You've got the Europeans talking about faster growth. I mean, is all well now with the global economy?
Well, we do think the global economy is continuing to grow at a solid rate. It's what we've been seeing is some slowing in places like China, in the U.S., and that's gotten a lot of concerns up that it's going to be a hard landing, especially here in the U.S. And I think what some of the more recent data have confirmed is that while, yes, growth has slowed as some of the temporary supports eased, we are not heading into a double-dip recession or even a sharp slowdown for that matter.
Do you think the financial sector, I mean, we realize now they've got 8 years to deal with these increased capital requirements. That's maybe a weight off somebody's shoulders, investors' shoulders, but you still have the possibility that they won't be able to pay dividends for a long time. Is that a concern, or is faster growth sort of alleviating that concern?
What tends to happen in these cycles is that as the economy gets better, and at the start it's not primarily driven by bank lending, what happens is production starts rising, incomes start to grow, and as that happens, banks start to lend a little more freely. And that is starting to happen. We're seeing banks on net begin to gradually ease lending standards, and this is the right time in the cycle for them to do that. And we don't believe that what came out over the weekend is really going to interfere with that in the near term.
Hey, Dean, does any of this change whether or not the administration and really Congress extend those Bush tax cuts?
Well, I think that's one of the critical issues right now. What we've seen of late continues to make that unclear exactly what's going to happen. We do think ultimately the most likely outcome is some compromise is found, but the risk scenario, I think, to our view as well as to many others, would be if there's no compromise and all of the tax cuts expire. That would provide a big hit to the economy in the first part of next year.
Enough to turn it back into a double dip here?
Not in our view. It would cause much more slowing in growth than would happen otherwise, but we don't think that by itself would be enough to cause the economy to start contracting again.
Hey, Dean, when you look at the options market, it shows an incredible surge in bearishness. You can hear it on the airwaves here at Bloomberg. We talk to economists who say we're already looking at negative growth in this quarter, and we'll see a minus sign in front of the number in the next quarter as well. What makes you disagree with them fundamentally? I mean, what's the difference?
I think one of the things that's, in my view, been a distraction to people has been the 1.6% reading on Q2 GDP growth, because many people take that and say, well, this is just the start of a sharp slowdown. Things are going to go down from here. But that was a very strange number in that domestic demand was very strong and trade had the largest drag in more than 60 years. We don't think that's going to continue. In our view, in the second half of the year, growth is actually going to be stronger at 2.5% to 3%, and that's, in our view, going to disprove some of this thesis that the economy is weakening sharply.
Does that mean also, Dean, that we start to see some kind of substantial improvement in those two big problems when it comes to the economy? I'm talking about housing and the labor market.
Well, the labor market has gradually improved, so it's important to stake out where we've been. We were in a period of sharp contraction. Now we're in a period of modest job growth. About 67,000 private sector jobs created last month, 79,000 on average over the last 3 months. That's not tremendous growth, but it is a big improvement. We think that gradual improvement simply continues going forward, and those job growth numbers improve.
What do you think about the housing market, Dean? I mean, do we stabilize here? Do we go back to normal? I mean, there was a time when home prices appreciated with inflation rather than going up 10, 20% a year.
Yeah, in our view, the housing market in the very near term is still trying to deal with the hangover from the homebuyer tax credit going away. So we had the homebuyer tax credit boost activity. Now we're seeing the drop off in activity. We think it starts to level off and move higher as we move through the second half of the year. In terms of prices, while we're not going back to the booming house prices that you were talking about, Matt, we do think that we have a bit of a slowdown, but that prices begin to rise as we move towards the year end.
All right, hey, Dean, thanks so much for spending some time with us. Really appreciate it.